The Accounting Equation and Financial Statements, Chapter 1 of Wild 6th edition. Using the chapter example, we will walk through the accounting equation and how financial statements are prepared. You may want to pause here and get your accounting equation out for Chapter 1 so that you'll be able to better understand what we're trying to accomplish. We're going to look at a series of 11 transactions and see how they affect the accounting equation. What is the accounting equation? Well, the accounting equation is assets, what we have, is equal to liabilities, what we owe, plus equity, what we own. So what we have, we either got it through one or two sources, either by borrowing to obtain it or by owning it straight out. So let's look at these transactions. First, this column will represent all of the assets, which are found on only one of the financial statements, the balance sheet. Next, we will look at the liabilities. Every transaction related to liabilities will be in this column, and liabilities, just like assets, are only found on the balance sheet. However, what we own, or equity, is found on a variety of financial statements, so we will look at those as we go through the transactions. In this instance, the owner invested $30,000 in the corporation. So the corporation received $30,000 and the owner received common stock in the amount of $30,000. Common stock, as far as an owner's equity account is concerned, is always found on the balance sheet and no other financial statement. Next, we're going to purchase some supplies which we expect to yield future benefits. If we had expected this purchase of supplies to only benefit the current period of the first 2 weeks of the month, or perhaps just the month, then this would perhaps be supplies expense. But since it's going to benefit future periods or future accounting periods, it's going to be considered an asset. So the hallmark of an asset is something that will benefit future periods. So our assets, supplies, went up by $2,500, but our cash, another asset, also went down by $2,500. So we can see that we have less cash and more supplies. This means, however, that total assets still only equal $30,000. We just have a different composition of assets than we had previous to this time. So the net effect of this transaction on total assets is zero. An asset went up and another asset went down. Next, let's look at purchasing equipment for $26,000 for cash. Well, in this instance, an asset, equipment's going to benefit future periods, went up by $26,000. Additionally, our cash, another asset, went down by $26,000. Again, total assets will be $30,000. We will have a certain amount that will be in cash, a certain amount of assets that will be in supplies, and a certain amount of asset associated with equipment. Again, total assets remain the same. Next, let's look at another transaction. We're going to purchase supplies. So as a result of having purchased these supplies are going to go up an asset by $7,100, but we purchased the supplies on credit. In other words, we did not use cash for it. So we owe on these. So what we have, we got by owing on it. So our accounts payable went up by the same amount, $7,100. Next, let's look at earning some income. So the business is open now for business, and now they're going to earn some income. So they provided services. They received cash for those services in the amount of $4,200. So cash went up $4,200. Consulting revenue, which is the type of service they provided, went up also by $4,200. Consulting revenue will be found on the income statement. The income statement will only have revenue and expenses. So revenue and expenses will only be found on the income statement, and it is found under the general heading of equity. So next, let's look at paying rent in the amount of $1,000. So cash is going to go down by $1,000 as an asset, and rent expense is all going to decrease owner's equity. So expenses decrease owner's equity. Again, we said only revenue and expenses are found on the income statement. Consulting revenue, $4,200, increased owner's equity. In this instance, rent expense decreased owner's equity. Next, we're going to pay salaries in the amount of $700. So cash went down by $700 because the salaries were paid. Salary expense is going to decrease owner's equity. And again, revenue and expenses on the income statement. So the financial statement associated with the equity account is going to be the income statement. Next, the corporation provides consulting services in the amount of $1,600. The consulting revenue will go on the income statement, and it's an increase of equity. And also, it's going to rent space to the same client in the amount of $300. So rent revenue, which increases equity, also on the income statement, is going to increase by $300. However, both of these transactions were on account, meaning that we didn't receive cash for that. We received a promise to pay, which is accounts receivable. So for accounts receivable, it means that the corporation is going to receive money. In this instance, when we purchase supplies on credit, it means that the corporation is going to pay out money. Next, let's look at the ninth transaction. Received cash $1,900 on accounts receivable. So now the client that promised to pay us in transaction 8 has paid us. So cash has gone up by $1,900, and our accounts receivable no longer exist because they have paid off the balance of $1,900. So we would not show that as an asset on our balance sheet. Next, we want to make a payment on accounts payable. We're going to pay out $900 in cash, so cash is going to go down by $900. Again, this is on the balance sheet. Accounts payable is also going to go down by $900 because we've reduced the amount that we owe. Dividends, the corporation is going to pay dividends to its stockholders in the amount of $200. So cash will go down in the amount of $200. Dividends reduce equity, so it's going to go down by $200, and that is on the statement of retained earnings. So dividends will be seen on the statement of retained earnings. Again, common stock increases equity, so it's a plus. Consulting revenue increases equity, so it's a plus. Rent expense decreases equity, so it's a reduction. Salary expense reduces equity, so again, it's a reduction. Consulting revenue increases, so it's a plus. And dividends reduce owner's equity, and so it's going to be seen as a reduction. So let's look at how these would look when we post these transactions to the financial statements. So here we have consulting revenue. So we have the income statement, which is always the first statement that we prepare when we prepare financial statements. Next, we prepare the statement of retained earnings, and after that, the balance sheet. And as we go through this, you'll understand the sequence for this. So the income statement we said was revenue and expenses, so we're going to add up all of the revenue. Now, a word here. We can see that this is a good dynamic for understanding what is going on in the books and looking at the accounting equation. But you could understand that if you were keeping your books like this and you had pages and pages of this information, the opportunity to make an error would be very great because you would have to make certain that you captured every revenue transaction in order to add them all up to come up with a total revenue for your income statement. So this in chapter 1 is used to teach you how the accounting equation works together, but in chapter 2 we will look at how the books are formally prepared. But right now we're just in a learning vehicle to see how everything works together. So consulting revenue, adding the $4,200 and the $1,600 together, we can see consulting revenue is $5,800. Next, we can see rental revenue was $300. So this is our total revenue. Next, we'll see that we had rent expense of $1,000. And again, it was just for the month. If this had been a prepaid, if we'd been prepaying for 10 months in the amount of $100 a month, then this would have been an asset called prepaid rent. But since it just relates to the current period, doesn't have any future benefits associated with it, it's going to be considered an expense. Remember, an asset has future benefits associated with it. So if this were for 10 months, then it would be future benefits and it would be prepaid rent. All right, now let's look at salary expense, $700. And so we add up all of the revenue, we subtract out all the expenses. Our net income is going to be $4,400. Now we're ready to prepare the statement of retained earnings. Looking at beginning retained earnings, since the company just began, there's no beginning retained earnings. Now we're going to use the net income that we've retained from preparing the income statement, and that's going to be transferred into the statement of retained earnings to show the total amount that the company has earned and retained so far since inception. So net income has to be calculated from the income statement, then added to the statement of retained earnings. Next, that's not the whole story of what we had added to the statement of retained earnings. Now we have to take into consideration the fact that a portion of this that we retained has been paid out in the amount of dividends. So here we have dividends, a statement of retained earnings, $200, a reduction. So we can see that our ending retained earnings will be $4,200. Next, we're ready to prepare the balance sheet. So we will add up all of the transactions associated with cash. Again, you could see that there would be an error if you were to make a mistake here and miss a cash account. So again, these are training wheels for learning about accounting, but you could see how an error could easily be made adding up all of the cash transactions. Next, accounts receivable. It went up by $1,900, but it also went down by $1,900, meaning that we have a zero balance in accounts receivable. Next, let's look at all of the transactions related to supplies. We can see that it's $9,600. Then we can see that we have equipment. So equipment was in the amount of $26,000. So that was what was added, $26,000. So we can see that our total assets should equal our total liabilities and owner's equity, right? Because what we have is equal to what we owe and what we own. Assets are equal to liabilities and owner's equity. So we can see that this is actually the calculation of the balance sheet.